Most investors follow trends. Very few develop edge. This show focuses on something different: how serious operators build durable wealth in overlooked niches, starting with mobile home parks. We'll break down the strategy, underwriting, discipline, talk about the roadblocks, and the operational execution that'll make your capital aligned with long term returns. This isn't about chasing deals. It's about thinking like an allocator and executing like an operator. This is the Mobile Home Park Exchange. Frank Rizzo back with you on the MHP Exchange podcast. I had this conversation with an associate of mine recently, and we were just talking about the evolution of this industry and the changes that we've seen over the last 5 years, probably more significant than we saw in the 10 years prior to that. The initial thesis, the drawer where a lot of people, and myself included, what drew people into investing in mobile home parks was, we've heard the consistent cash flow. You could acquire these assets really below their intrinsic value, right? There's this asymmetrical risk return ratio. And even in your value add assets with some easy levers of modernizing books and records and doing some site beautification and cleanup, you could have an asset with a double-digit return because there was already a predictable income stream. And so what ultimately ended up happening as that story got out, more people, more capital found its home into the mobile home park space. And last year, I believe, roughly 50% of the deals that went off last year, there was some institutional capital behind it. And it has pushed average pad cost or lot cost across the board significantly higher over the last 5 years. I mean, roughly nationwide, you're somewhere between $45,000 to $50,000 a pad, and in your major metros, you're at $100,000 a pad or better. And so now the initial thesis of why people got into mobile home park investing, does it still exist? It does, but it also has created some different operators who are coming in with some different strategies. I've been talking with somebody who I know in a market close to ours, and their focus, there's an operator there where their focus is buying or acquiring smaller parks, which typically trade at a little discount. And a lot of times he could find them or source them from independents. And he's paying somewhere between $60,000 to $65,000 a pad, knowing that when he can aggregate a few of them, he's able to exit at somewhere between $80,000 to $85,000 a pad. Now, he's not buying these communities for cash flow, right? That's not his game. He's buying those communities because he knows he has a read on the fact that there's larger buyers in that market that are willing to buy between $80,000 and $85,000 a pad. And that's the spread and that's the margin he's working on. So it's not that he's wrong about the math, right? He's not looking at this from a cash flow perspective. He's making a very specific bet. And that bet is that there'll be larger players with larger pools of capital that are willing to aggregate in this market and pay more per pad. And he can do that work for them. And he can make that spread. He's not wrong, but it's not the original reason why a lot of people got into mobile home park investing. Another theory, right? And I call it a theory because the rule of thumb, you're looking at buying a stabilized park in a prime area, somewhere between a 5 to 6% cap rate, and you'd want to buy a value add park somewhere between 8 and 10%, right? That's the theory, right? That's what we've been told. And that is great when you can find it. But I got to tell you, it is getting awfully challenging to find that in the market today. That's not that it doesn't exist. I mean, there is still a number of independent owners who are looking to exit across the board. But a lot of these communities have traded over the last few years. There's a lot of people. I was speaking to one owner recently. He showed me a list of 43 people who had contacted him in the last 12 months, willing to make an offer on his property. And I would tell you, there's probably one or two of them that actually went on site to see the asset itself, right? Me being one of them. So the old rule of thinking you can find a value add asset in a secondary or tertiary market between 8 and 10%, harder and harder to come by. And if you wait just for that deal, you are going to be sitting on the sidelines for a lot longer than you expected. So, but how do you mitigate that risk? How do you mitigate that risk of investing in a value add deal, knowing that you've got additional capital that you're going to have to deploy to make that community, that asset, that investment work? Well, one of the things that we've looked at is making sure that we have synergies in the market. We can get more aggressive in markets that we've already got boots on the ground. And I've said it before, and I'll say it again. The biggest moat that you have in this industry is operations, is your operational alpha in the markets that you're in. So when we had the opportunity in a market that we're in, Troy, Alabama, to acquire a value add portfolio, but for us to be in the game, we knew we had to acquire that value add portfolio at a 5 cap, which I got to tell you isn't pretty on the surface. But how did we make that work? And how in 60 days are we now ahead of schedule in our business plan? Well, we knew going in, because we've had a relationship with the owner for such a long time, we knew going in that he didn't run the community for operational efficiency. He ran it because it was a lifestyle and he wanted convenience. And convenience, a lot of times for an owner, meant I'll keep the rents the way they are, even if everything else went up. Maybe I'm not going to make the improvements I need to make, or I'm going to reinvest the money I should to keep that park up with the times. And we knew going in that that these rents were 52% below our nearest competitor in town. 52%. So going in, making our offer, where we had to make our offer, and knowing full well there was a group out west. Now, they hadn't been to the community, and they're not in that market. They were willing to pay a lot more than we would. But knowing that, we were able to secure the deal, and knowing that if we went in with a retrade, we probably lost the deal. Right? We were going to lose this. So how did we make this work? For us to, if we couldn't make one number work, we had to make the other number work. Now, one of the things we don't like doing, and I've spoken to other operators about different ways of how they like, how do they like to guide closer to market, because you have to make that community work, especially at the new numbers that you're going to have to pay to make the deal execute. Fortunately for us, we had a seller who was aware of the situation. And for us to make his number work, he had to get closer to make our number work. And it was a lot easier for him with the relationship he had with the residents to give us that first rent bump before we took possession. So the first raise that we had wasn't even on our watch. It was the current owner who had those conversations and guided rents closer to where they needed to be. He didn't close the gap, but we went from 52% below market to 35% below market, which is a huge difference. And it allowed us to make those numbers work. And the second reason why we could get more aggressive is because by having that operational moat, by having those boots on the ground, we knew that once we were closing, we had the ability to execute quickly. And what did that mean? That meant that homes that were going to be unit turns, we had people in them right away, right? Our team was getting those units ready for market. And we've already been able to resell a number of homes and getting new residents in place. And we were able to order new homes and get those lots up and ready and to go. So within 60 days, we had brand new homes on site and showings happening right away. So that's a huge value add for the community. And new residents obviously are coming in a lot closer to market as you're moving those legacy residents up. So now as that starts to roll in, we're able to win back some of that control. So the industry has definitely evolved. The industry has definitely changed. I mean, you're not going to have 50% of the purchases happening in this industry in any year like it was last year without that having a huge effect on value and strategy that you need to take to be successful. Capital has absolutely found a home in the mobile home park industry right now. Prices, because of that, have moved. And the easy version of this business is gone. That doesn't mean it's completely gone, but if you're relying on the easy version of this business, sorry, you're out of luck. What's still up for grabs is what you do with what's happening right now. Now, one path is what that operator is doing, with the smaller parks, aggregating in a market where he knows somebody's willing to pay more because he knows maybe those small parks won't necessarily cash flow for him. And the other path is what we did, where you can get aggressive in markets where you have an operational moat, where you have a real read on the levers you need to pull and how you need to pull them to get to where you need to be. And you could get better control of your own runway for growth instead of sitting on the sidelines and waiting for something to fall in your lap. This industry has evolved, and there's some different bets on what happens next. This has been another episode of the Mobile Home Park Exchange podcast. If you found value in this episode, I ask you to do one favor and one favor alone on the streaming platform below, wherever you're listening to it. Just give us a rating and send us some feedback at Mobile Home Park Exchange. Let us know that you've done that. And for doing that, I'll share with you our after site visit report. That's my free gift for you for helping us get the word out on the value of investing in mobile home parks and creating affordable housing options. Until next time, everyone, happy investing.